A super easy investment strategy. There's no way I'm being serious, right? Well, indeed, I am. So welcome back to our beginner investment series here at The Financial Bartender. This is episode 3 of our beginner investment series. If you have yet to check out the first 2, I suggest you do that first. I'll link those above. So far, we have explored stocks and bonds. And today we are going to dive into this super easy investment strategy that I have promised you, and that is investing in a fund. And as they always say, you can't spell fund without fun. Well, actually, I guess nobody says that. If you survived that awful joke, you're going to want to stick around for this video. We have a lot to unpack. So guys, let's check it out. If you are new to The Financial Bartender, our motto here is very simple. We build wealth, we build productivity, and we build self-improvement on a bartender's salary. And if you are enjoying this content, please consider subscribing to the channel. We would love to have you on this journey. So as I mentioned before, we have already taken a look at stocks and bonds, and I feel like the logical next step, especially when we're approaching investing from this beginner's perspective, is to look at investing in a fund. When you invest in a fund, you are investing in a collection of assets. In other words, you are investing in an entire portfolio of stocks. And you can already see the differences here from stocks and bonds. When you invested in a stock, you were investing in one thing. You were buying an ownership stake within that company. And when you invested in a bond, you were paying out a loan, you were receiving that payment back plus interest. But when you invest in a fund, you are investing in a whole portfolio of assets. And there are 3 different funds that we are going to look at. We're going to look at mutual funds, index funds, and ETFs, or exchange traded funds. Man, I'll tell you what, saying fund a lot, funds. It sounds like I'm just saying funds without the D. Kind of tough to say. Anyways, let's start with a mutual fund. If I invest in a mutual fund, that means that I go to a financial advisor or a fund manager, and he's going to select a portfolio of stocks, handpicked himself, that he believes will outperform the market. And this is what we call an active management style, because there is someone actively managing your fund and your portfolio. Because of this, you will pay higher fees than you would on a different type of fund, but we'll get to that in a bit. But just know that because someone is actively managing it, they do have to receive some sort of payment for that, so you will be paying higher fees. But like I said, this fund manager is going to be selecting a portfolio that he believes will outperform the market. That brings us to an index fund. When you invest in an index fund, there is no active fund manager or financial advisor. So this is what we call passive management. These are usually predetermined portfolios of stocks that are simply tracking a pre-existing index. Let's use the S&P 500 for an example. The S&P 500 is the 500 largest companies in the stock market. So if I invest in an S&P index fund, I'm investing in a fund that is trying to mimic and follow those stocks. With a mutual fund, we were assembling a portfolio of assets that we believed could outperform the market. With an index fund, we are just trying to follow the market. And believe it or not, index funds over time have been proven to perform better than those portfolios that are trying to outperform the market. So if there is a lesson to be learned here, don't try to beat the market. And then because index funds are passively managed, these are going to have lower fees than a mutual fund would. And lastly, we have an ETF, or an exchange traded fund. These are very similar to index funds, except that they are allowed to be traded on an exchange, hence the name exchange traded fund. They are allowed to be traded on an exchange throughout the day at any point, just like you could trade a stock throughout the day. With index funds, you can usually buy and sell at the close of day. It's not really something you can do throughout the day, but ETFs give you full control over when you want to sell. So real quick, I want to show you an example of what I mean when I'm talking about entire portfolios of assets. What I have pulled up here is the Vanguard S&P 500 ETF. And what you'll see right here, I've come to the largest holdings within this ETF. As you can see, 7% of the fund is Microsoft, 6% is Apple. You see all these other big companies in here, NVIDIA, Amazon, Facebook. And these are just the largest percentages within it. As you can see, you get to Tesla, you're already at 1.27%. But the point that I'm trying to make is within these ETFs, within these funds, whether it's a mutual fund, index fund, or an ETF, you have a large collection of stocks. So now we come to the part that everyone has been waiting for, and that is why I called investing in a fund a super easy investment strategy. Number one, investing in a fund offers you lots of diversification. When you're putting together your investment portfolio, you want lots of diversification. Let's say you're only invested in technology. If that sector takes a nosedive, then you're going to feel it in your investment portfolio. But if you're invested in technology and healthcare and real estate, if the technology sector takes a nosedive, those other sectors are going to keep you afloat. You're going to be feeling fine. You're going to be feeling protected against the downturns in the market. I'm back on this Vanguard S&P 500 ETF. If we look at the portfolio composition, you'll see that 29% of it is in technology. But you have a lot of other sectors represented here. You have industrials, healthcare, financials, a little bit of everything here, utilities, real estate, materials. You aren't in one sector, you're diversified amongst many. When you have a diversified portfolio, it only helps to set you up for success. And then the second reason that I called investing in a fund a super easy investment strategy is that it takes the guesswork out of selecting stocks and securities to invest in. I don't know about you guys, but I don't have the ability to predict what stock is going to go crazy next or the next big thing. When you invest in a fund, you're investing in a little bit of everything. Look at the S&P 500, for example. That has an average yearly return of 11%. Over time, you know that the money you put in is going to make money. You don't have to lose sleep. You don't have to stress about trying to pick a winning stock. You invest in a little bit of everything, you will see success. And I want to finish with this. We've now looked at stocks, we've now looked at bonds, and we've added investing in a fund. 3 things that you can begin to invest in. And here at the Financial Bartender, what we want you guys to do is begin putting together a portfolio that works for you. Maybe you invest in a couple funds and then you add a couple stocks that you really believe in. And maybe you add a bond for some protection purposes. You can see how your portfolio can start to take shape. Everybody is going to be different, but we hope that these first 3 videos have laid the groundwork for your portfolio. Thank you.